How to build a tax-free retirement the right way. Today, that's what we're all about. That long-term planning, that generational wealth. Let's put some monies away for the long haul and structure in a way where we could pass it on tax-free to that next generation. At this point, I hope all of you have heard about the 401k, but unfortunately for a lot of individuals, that's where their retirement planning ends. They fund their 401k every year and that's it, but they don't know any better. Either they're not getting good advice from their accountant, or even worse, they don't have an accountant and they're just free falling. They've never had anyone explain to them the various different types of accounts there are. And that's what I'm here to break down for you guys today for both business owners and individuals. What is the order of operations? Go back to your grade school math class. You learn the order of operations, PEMDAS. We're not doing that today. But there is a right and strategic way about funding for your retirement. But before we dive into that, hello everyone. Hi, my name is Andrew D'Amico, CPA partner here at Leisurely alongside Mike, where we're constantly giving tax saving strategies, asset protection strategies, and that third piece, helping our clients build generational wealth, which is what today's topic is all about. So with that, right to our whiteboard, I got a blank slate. So first things first, let's understand the various different types of retirement accounts. So we'll start with the easy one, the 401k, which is offered by your employer. It is an employer-sponsored plan. When you're enrolled in, both you as the employee can contribute, and typically the company is going to offer some sort of match for your contributions. Common practice is, hey, we'll fund 3% of your salary into your 401k. Now, granted, you have to contribute that same amount in order for them to match you, but it's a nice little benefit that employers give. And as it pertains to the account, commonly you'll see Roth and traditional accounts. You can choose where your money goes into, and your employer will typically match in traditional dollars. It depends on the plan. And sometimes there's also this after-tax account that could be funded as well, but that's for later in the discussion. Contribution limits for a 401k are $23,500 for the employee. You, as the individual, in 2025 can put away $23,500. If you're over the age of 50, there is a catch-up that will allow you to put in an extra $7,500 if over 50. And then the employer will go ER. Let's say in this example, we say they're going to give a 3% match. So you have a $100,000 W-2. You put in $3,000 into, let's say, your Roth 401k. The employer will match $3,000 into your traditional 401k. So that's one account in this equation. Next is going to be the IRA. It stands for individual retirement account. And as it states in the name itself, individual, this is not related to an employer. You go out as yourself and set up an IRA for you. So this is individual, and this can also be, like I said, Roth or traditional. Keep spelling traditional wrong. Tradition, yeah. I think I'm an accountant. Hang around Mike too much. He's not the greatest speller. There are different income thresholds when it comes to getting money into these accounts and the taxation of it on your tax return. Is it deductible? Is it not? And hey, I can't contribute straight to a Roth because I make too much money. Yes, those are all considerations. But at the end of the day, the main requirement that you need for an IRA is you need earned income, operational income. Whether that's from a day job or you're self-employed, you're running operations, you need operational income. So you can't fund an IRA if all you have is passive investments giving you income, like a long-term rental or stocks, interest, dividends, those types of things. If that's all the income you have, you wouldn't be able to fund an IRA. Following the IRA, we have the HSA, the Health Savings Account. This is the triple threat, we like to say, because you get a tax deduction for contributions going in, the monies grow and come out tax-free, and you can take it out before retirement. I know we're talking about retirement here, but you can actually get those monies out prior to reaching retirement age, so long as they are for qualifying medical. So we like to include that in our equation. So this is tax-free. We get a tax deduction and reimburse medical. And I failed to include on the IRA before. You can contribute yourself up to $7,000 every year, and you get a plus $1,000 if you are over the age of 50, similar to that provision for the 401k. HSA, if you are on a single plan in 2025, you can contribute $4,300. If you have a family plan, that amount is $85. Moving right along. Once we get past this, what's going to enter in the equation is also the solo 401k. I'm not going to draw that up here because it's a 401k account at the end of the day, but I just wanted to give you guys at least a quick breakdown on the three primary accounts that are going to be in our order of operations as it comes to retirement. So with that, remember these numbers, burn them in your head. I mean, I could draw them up again, but those are contribution limits, taxation effects, yada, yada. So now, which one do we want to fund first? I like to think of it in terms of steps and it'll probably be easier if we get a little case study here. So let's start with a taxpayer. Let's say we have a single individual. They are, I don't know, 40 years old for whatever reason, just so we don't have to worry about the catch-up provisions. So they're under that. They're single. They have a W-2 day job. They work for someone else. That is $100,000. And let's say they have their own little side hustle. Maybe an S-Corp in the picture, but I'm just going to write LLC. Just no side hustle income. They're earning money on the side. Let's say they're making $50,000. So that is our avatar for this case. And now let's go through the steps. Where do we want to start first? So the bottom here, let's get our steps. See if I have to draw another one. But bottom level, where we want to start is at our day job 401k. And the reason we start here is because, hey, if they're going to offer us a 3% match, if I can put $3,000 and get somebody else to give me another $3,000, that's 100% rate of return. Yeah, I'm going to take that. It's free money. So let's say in this case, we'll say their employer offers a 3% match. Let's say as the employee, we throw in $3,000. Let's give a name to our guy here. Let's call him John. That way I'm not referring to myself. John throws $3,000 into his Roth 401k at work. Fantastic. He gets a 3% match. His employer is going to put in $3,000 into that traditional 401k. Again, that's how most old 401ks are set up. That's where we want to start. We don't want to put in more than $3,000 at the day job because we're not going to get any more than that from our employer. As soon as we put in $3,001, the employer contributions cut off in this example. Depends on the match, but I want to take my money and put it elsewhere because, hey, if I set up my IRA, HSA, or solo 401k and I can self-direct it, I have the opportunity to make higher returns on my investments. Whereas at my day job, I'm going to be limited to stocks, bonds, and mutual funds. So we recommend, hey, get up to your match, get up to that $3,000, and then get out. And then you move over to step 2, and that's going to be our IRA. Now, again, there are income limits for a single individual in 2025. If you are making over $150,000, your modified adjusted gross income, you can no longer contribute directly to a Roth IRA, and you would have to go to a traditional account first. But in our example, let's say we're under that 150, we're right at 150. So we're going to put $7,000 right into Roth. And we recommend Roth because over the long term, hey, our monies are growing tax-free and they're going to come out tax-free. I want to pay tax on growth. I don't care that I can get a $7,000 deduction through traditional IRA. I'm not retiring for a long time, so my growth is going to be much more than my contributions over the years. So step 2, we say get to your IRA. Next up is the HSA. John is single, so we're going to say he has a single plan. And again, that number is $4,300. So that's where we are going to go next. And some arguments could be had that, hey, these steps could be flipped. Depends on your situation. If you have a family, you have young kids, or maybe somebody has an ailment or a disability where you're going to have higher medical, then okay, maybe you want to fund the HSA first because you're going to need those monies. But typically we say IRA, then the HSA. So up on step 3, we throw in our $4,300. Great. And then when we get up to this point, if we've invested all this money into our retirement in this current year and we still have more money that we can play with, okay, John's got a side hustle. Let's set up a solo 401k. And if you refer back to the first screen, the first board, you can contribute up to $23,500 to a 401k. Now, that is to all 401ks you might have. So it's not you can fund $23,500 in here and then another $23,500 up here. Nope, that's between the two if you have multiple 401k accounts. So we're going to set this up. We're going to self-direct it because we're going to earn higher returns because we know what we're doing with our money. We already put in $3,000, so that means I can put in another $20,500. And John is on the Roth method. He likes that tax-free growth. So he's going to throw $20,500 into Roth. Depending how he's set up and if he has a W-2 in the mix, a solo 401k can match up to 25% of your compensation. So for argument's sake, and make this simple, let's say his W-2 is $50,000 from his side hustle. 25% of that is $12,500. We'll say traditional, make it simple. Pretty impressive board so far. We got what, 6, 13, 17.3, and then another 33,000, call it. So we put in $50,000 into our retirement this year. But it doesn't end there, even though I'm running out of space on my whiteboard. If we get to this point and we still have money we want to put away to retirement, we don't have any other investments or reinvesting into the business that we need or want to do, and we're okay with putting more money away for retirement. Remember that third account I listed on the 401k, that after tax account? This is where the next step, we do the mega backdoor Roth. And that's where this after tax account comes into the picture. You'll note $70,000 is our limit for a 401k. Currently, we have $6,000 right here. And then right here, we have, what is that? I think I said 33. So you add this and that. Hope you can follow my chicken scratch here. We have $39,000 in our 401k for the year so far. If we take out the max, which we are allowed to get to, that means we can put away another 31,000 into the 401k. But how do we do that? This amount is going to go into the after-tax account in our 401k plan. So now we've got $70,000 in the 401k, got another $7,000 in the Roth, and then we did the HSA. We put over $80,000 into retirement in just 1 year. Now, are you going to do this every single year? No, especially if you're self-employed. You're going to have ups, you're going to have downs, day job, maybe you get laid off. Again, a whole host of things that can happen. But if you have this opportunity, we highly recommend you take it, especially if you're focused on that long-term, that wealth building, because the more we can fund it on the front end, the more opportunity we have to grow it to where we're just chilling in retirement. But my friends, it doesn't end there. So first things first, make sure you keep this burned in your brain. So let's get a clean sheet, because you noticed there was a combination of traditional and Roth monies in there. And what did I open this saying? How can we build a tax-free retirement? Well, the after-tax, the growth in that account will be taxed, and the traditional monies will also be taxed. So I just want to paint a picture for you. And disclaimer, this is not going to be drawn to scale, so I apologize. But let's say on our x-axis, we have years. I'm young, so I'm going 40 years. We're talking retirement, and we'll do this in increments of, I don't know, $500,000. Terribly drawn, but it'll make sense in a second. So if we are putting away, let's just use the solo 401k as an example, $70,000 a year. Let's just assume, for argument's sake, that we're putting in $70,000 every single year for all these years. Don't worry too much about the number. This is just about what I'll explain in a second. So after 10 years, we would have about 700,000, which would put us right over this 0.5. After 20 years, we'd be at like 1.4. So really like right there. And then we're just going to assume the rest is going to be drawn to scale. Whether that's right or wrong, after 40 years of $70,000 a year, that's 2.8 million. So that would put you like right here. So again, like I said, not the most accurate drawing, but it'll be close enough. So that is just my contributions. The growth in the account, average IRA account, is about 6 to 10% a year when just in stocks, bonds, and mutual funds. So our account balance is going to be greater than our contributions. But the growth really doesn't start kicking in until we get to, that 20 to 30 year mark, and then especially in the 40-year mark, where you have such a big balance, those returns are significantly higher. So your growth and the actual account balance would look more like this, and it gets exponential at the end. Now, how we can have a tax-free retirement is we want our 401k contributions or retirement monies in general getting into that Roth bucket, because if it's Roth, if all of our contributions are Roth, we don't have to pay, and our growth is off the screen. But, if we're into the millions and millions and it's all Roth, all this money is tax-free. But if it was kept in traditional dollars and you were chasing that deduction in the year you're putting it in, now not only do we have to pay tax on all of this because we got the deduction in the first year, but we also just signed ourselves up for another tax bill for all the growth in the account as well. And so to avoid this problem moving forward, if you do have to utilize the traditional accounts and the after-tax accounts in your 401k, we recommend on day 2, you convert it, you chunk it over into the Roth bucket way over here. Whenever you're putting traditional monies in, we want to convert it to Roth as early as possible, because the growth is going to be incredible on the back end. And if it stays in traditional, we're just signing up for all that tax on this extra growth over here. Terrible shade job. I hope that makes sense. I don't want to confuse you guys, but that is how we get to the tax-free, comfortable retirement, is when we have good years, putting away those monies by whatever means necessary. Again, starting with that day job 401k if we have it, moving to the IRA, HSA, and then the solo 401k or our self-employed 401k. And then just day 2 with any of those monies, even with the IRA, you might be over a certain threshold where you have to do a non-deductible traditional contribution, but then we convert it over to Roth on day 2. And then in the long haul, we don't have to worry about all that growth paying tax on that. So everyone, I hope this made sense. Please leave your questions, comments. Would love to interact with you. Please subscribe to this channel if you like hearing more about tax strategies and especially that generational long-term wealth. See you guys in the next video.